Hey guys, what's up and welcome. In today's video, we're going to be taking a look at two CNBC clips. We've got Mohamed El-Erian and Sarat Sethi's thoughts on the economy. First, with Mohamed, he's saying buyers are hesitant in view of what's happening to the supply of government debt. Then we have Sarat saying we're peaking in terms of economic activity, but not inflationary activity. So we're going to jump into these videos. As always, guys, if you enjoyed them, smash that like button. Let's get started.
Slide in technology stocks and the volatility in the Treasury markets. And joining us right now to talk more about that is Mohamed El-Erian. He is Chief Economic Advisor at Allianz. He's also the president of Queen's College at Cambridge University and the co-author of the new book, Permacrisis, A Plan to Fix a Fractured World. Mohamed, let's just talk, first of all, about the economy, because we've got the GDP coming out in just about, I don't know, less than an hour's time from now. That's expected to be a strong number, but there are so many questions swirling about the economy. Where do you think we stand right now?
Just right before he answers, guys, we did get the GDP, and it was a little better than expected.
Morning, Becky. I think the number is going to highlight two things. One is U.S. exceptionalism continues. Not only is it going to be more than double the rate of 2.1% for second quarter, but it outpaces all other advanced economies. The U.S. has been the growth engine for the world. It also highlights the challenges the Fed faces. But what we should not do is take this as a signal of the all clear for 2024. As you know, I've always pushed back on the notion that we would have a recession in 2023. I'm a little bit worried about 2024.
Early 2024, late 2024, how do you see this playing out?
It's hard to tell. I mean, we have first the rundown in savings. That's a big issue. Secondly, what's been happening in the interest rate market is really problematic. It's problematic for businesses. It's problematic for governments, for the Fed. It's problematic for households. And that is a significant headwind to economic activity.
Okay, let's talk about the volatility we've seen in the Treasury market, because that's been dictating the stock market moves lately, too. Where do you think the direction is headed? What happens next in terms of the yields and why?
So we know
They seem a little pessimistic today. I guess maybe that's why the markets are absolutely crashing, guys. Don't forget we have Amazon earnings at 4 o'clock. And guys, it's a bad day in the markets. We've got all big tech down anywhere from 2.5% to 4.5%. And we're at the lows of the day around 1 when I stopped watching. So when I get back to it, I'm not expecting anything pretty.
Two things for sure. One is that we've lost the anchors to that market. We've lost the economic anchor, we've lost the policy anchor, and we've lost the technical anchor. Second, when it comes to simple supply and demand, there's two things that are here and are going to stay here. The Fed being a net seller and the government issuing more debt. So the question mark, and you saw that in the auctions yesterday, is who's going to buy? And that question about buyers isn't going to go away anytime soon. You'll hear all sorts of images of catching a falling knife and things like that. And it is a problem because buyers are hesitant, and they should be hesitant in view of what's happening to the supply of government debt.
I'll give you a couple of points of pushback on that. First of all, people are reluctant to be buyers. Governments are reluctant to be buyers unless they look at the potential for conflict around the globe. Geopolitics may dominate and push them to a position where they say, we're looking for a safe haven. The U.S. Treasury is still going to be that, correct?
It should be that, but let me give you some numbers. Before the conflict started in the Middle East, the 10-year Treasury was at 480. Today it's at 497. And we still face the risk of escalation of that crisis. You know, there's been two big puzzles, and they speak to how unsettling the volatility in the U.S. Treasury has been. One is you haven't had it been the safe haven. We haven't seen the flight to quality and the flight to safety that you would expect, given what's happening in the world. The second thing that's equally counterintuitive is you have people talking about Bitcoins, about equity being the safe asset because they've lost confidence in government bonds being the safe assets because of the nature of this interest rate risk. So yes, it should be the safe haven. It should have already benefited, but the reality is that the 10-year yield today is a good 17 basis points higher than it was before this latest conflict erupted.
Mohamed, if the Fed says it's going to keep rates higher for longer, and I believe them if they think that inflation is still a problem, that they will not lower rates. But if push comes to shove and there's nobody else buying treasuries, I dispute your first point, your first given, which is that the Fed is going to be a seller of treasuries. I just think if push comes to shove, they would be more likely to stop selling treasuries than they would be to lower rates.
That's a possibility. The question mark will be, do we have both economic weakening and do we have some sort of scare about a market accident? If we have those two things, then rates will come down. Look, messing around with QT is not that simple. What the Fed has wanted, what the ECB wants, what all central banks want is that the reduction in balance sheet be like watching paint dry. Predictable, gradual, nothing to see there. That's what they want.
Yeah, Becky, they want that, but they also want markets to not react in a horrible upheaval. And I don't know which one would win out if those issues all came to a head.
So we have a press conference next week. That would be a great question to ask Steve, okay, as to how flexible is the approach to QT right now.
Mohamed, your new book is Permacrisis, a plan to fix a fractured world. We've got 40 seconds left. How do you fix a fractured world?
What a great title for a book, guys. The plan to fix a fractured world. That is exactly what we have right now. I'm interested to hear his thoughts, and then we'll wrap up the video.
Fix three things that are all fixable. I mean, this is a book that's full of hope. One is you alter the growth models to grow more inclusively and respectful of the planet. Two, you stop making these policy mistakes that we've made. And third, and perhaps most difficult, is to try to enhance cooperation, global cooperation, where there is a global challenge. These are feasible. There are engineering solutions for all three. We just need the political leadership.
Those are all a lot of great points, guys. I'm definitely going to have to check out that book. I bet it will be very interesting. But back to the government debt situation, guys. We've got China unloading their debt, Japan unloading their debt. We're unloading our own debt, guys. We've got nobody to buy it, and it is a bad sign. You topple that with everything else that's happening in the economy. Now we got stocks falling, rates rising. The Fed still hasn't done what it's needed to do. We've got elections coming up. We've got the Olympics coming up. We've got more earnings coming up, guys. We have so much big news in this stock market. It is going to be very choppy, to say the least. Now we're going to jump into Sarat Sethi's thoughts on the economy, guys. As always, I hope you're enjoying the video.
Earnings and market action. Sarat Sethi, managing partner at DCLA and a CNBC contributor. Has anything changed your worldview with what we've seen in the first 2 or 3 weeks of the reports?
Well, I think it's interesting when you look at companies and you talked about, Alphabet saying, hey, we're going to spend more money, so then they get penalized. And if anyone says our next couple quarters is a little bit uncertain, you're going to see your stock sell off. So you see that with Meta. So unless you say, hey, we're going to make our earnings for the next couple quarters right now, it's sell first, ask questions later. And honestly, when you have a 10-year at 5%, there are other options. So the short-term kind of trade is, if I don't think the stock's going to do well for the next couple of quarters, let's move out. Now, that's not what we're doing, but I think you see a lot of retail doing that, and you're seeing algos do that.
Do you believe companies that say, yeah, everything?
That is a terrible thing to do, guys, in my opinion, to sell at the lows. You never want to sell out on fear. If anything, you either hold, or if you're going to do something, you add and you leverage down, you bring your cost average down, and you wait for it to ride back up. Now, that's obviously goes for good blue chip companies or good solid companies that you know the fundamentals of that are going to keep growing into the future, not just any penny stock. But assuming you have a stock that you've done research in and should more than likely keep growing into the future, you never sell at the lows, guys. You add to them and you hold on to your position for sure.
Things great for the next couple of quarters, or seems like there's so much uncertainty right now?
Yeah.
Like, you're sticking your neck out if you're telling me everything's great.
You really are. So it's kind of the, hey, if we think, we're going to make our expectations for a year or two, it's much better than saying we're going to stick by the next quarter. But right now the market's saying we have other alternatives. So if we don't like what you're doing, especially with the Magnificent Seven, I mean, I think they were put up on such a pedestal that it's going to be very hard for them to maintain these multiples. And then you're seeing that kind of spread through the market as well.
That's exactly what's happening today in the markets, guys. The Magnificent Seven, their earnings are good, but maybe their guidance isn't the best. And when you tell people that they can get a 5% risk-free yield, a lot of people are taking that offer, and it's a no-brainer. And that's why these stock sell-offs are nasty, because once it happens, it triggers more and more and more. Then we start breaking supports. Guys, it can get ugly really fast, and then all of a sudden we're back at the 2022 lows. So this is nothing to play around with. We're definitely going to have to be watching these next few weeks.
I don't know when headline issues are the most important thing for the stock market, but when you say uncertainty, are we still talking about the Fed and interest rates, or are we talking about this world we're living in?
Well, I think it's a combination.
And it can influence each other. I guess the wars can influence
right.
the Fed and the economy.
It's multiple now. Now it's not just one, and the uncertainty there, and then it rolls over into the price of oil.
Right, that too.
And then it rolls over into our interest rates, and the uncertainty in the interest rates was already causing volatility in the market because we just don't know. Are we higher for longer? Or are we going higher too? And if you get strong prints in GDP and all the inputs for inflation, you've really got to fed that stock. So in that sense, multiples have to come down, valuations have to come down. And in the short term, the interesting part for this, Joe, is you can find good companies here, but you just have to be patient if you're either holding them or you actually want to go buy them. So,
but you would say that there really haven't been, with big tech, any major disappointments in the last 3 months. It's mostly concern about the next 6 months.
It really is. It's concern about the next 3 to 6 months in terms of where earnings are going to go, where is cash.
The Magnificent Seven are releasing phenomenal earnings. It has everything to do with guidance and nothing to do with the actual earnings of the stock right now. In today's economy, there's so much going on, especially with this conflict in Israel. We've got inflation so high. We've got stocks, some of them at all-time highs. We've got a lot of room to give and a stuck Fed. That is not something that we want to have both happening at the same time. That just equals stocks having to come down.
Cash flow going to go. And then you have an election season coming too, so you've got that uncertainty as well. I think once we get some clarity on interest rates, and I think the market will adjust pretty quickly, and you'll see M&A activity also. Every bank has talked about one of the reasons we can't do anything is because people just can't get their arms around where capital markets are.
Kind of weird that when there was no Speaker of the House, it was possible we were going to run into shutting the government and not having the funding again. Now we got one, and did no one really believe it, or it doesn't matter, or?
Nobody believes it, but I think you kind of had to have one because we're going to be spending all this money, giving all the money up for defense as well.
For defense, but it really, I never saw a blip either way in stocks or bonds.
No, and I think the market's starting to live with that. So once you kind of know that's expected, it's the other stuff.
Right, are we going to fall off? Is this last print here in GDP? Could we be a half or a third of what we print now in the next quarter?
I think so.
I
think we're peaking in terms of economic activity, but we're not peaking in terms of inflationary activity. I think wages are still going up. You just saw today Ford. I mean, that's going to flow through to GM. It's going to flow through to the others.
And it's got to flow through to, it can't just be the big three or a couple of companies or union. Unions can't call the shots overall in wage, but there is wage pressure across the board.
There is wage pressure, and you've seen it in the autos, you've seen it in the airlines, you saw it in UPS. So I think that's going to be consistent. The thing to watch for is not the GDP growth. It's really the input growth of where are commodities going to be, where are we going to get higher inflation costs, and what's sustainable versus what's short term.
A lot of great things to look at from Sarat Sethi, guys. I hope you enjoyed the video. I've got to get back to the market. If you guys enjoyed it, smash that like button, and I'll catch you in the next one. Peace.